Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the state of the economy as we wind down 2025. First, I want to say thank you to our sponsor, Trust and Will, for making this episode possible. Logan, welcome back to the podcast.
It is wonderful to be here. Happy Friday. Thanksgiving's not that far off. It's great to be an American today.
It is, even though we don't have jobs data, which I know hurts your heart not to have the official jobs data.
You know, it's interesting because, normally I'd be sitting here today and we'd go over the jobs report and jobs week. But one thing I found interesting about this week is that there really is enough other data lines on the labor market with Revelio and other private sector to kind of get a good idea of what's going on. So the Federal Reserve is not totally in the dark. There's all the, of course, we don't have housing permits, new home sales, there's retail sales, there's stuff that's very important to the economic cycle. But on the labor data, it's good enough, right? That's the one thing I'll take out of this week, that there's enough private sector data out there to give you a rough idea of where things are at.
So Logan, here we are in November officially. What is the state of the economy right now?
It's very interesting now that we've gone through this jobs week. We do have enough labor data to get an idea there, but let's just take the facts right now. Now, if I took the Atlanta Fed GDP tracker data, which things are going to be a little bit suspect this quarter anyway, 3.94% GDP growth. We have a lot of CapEx spending in AI. We have a lot of data centers being built. When I saw the ISM service sector new orders popped. Okay, that's a very positive data line. You don't ever see that ever happen in a recession in history. We don't have retail sales data, but the consumption data is holding up. However, we look at some earnings like Chipotle and some companies, fast casual dinings, they're all missing earnings out there. I'm pretty sure the Fed probably likes that because they think that if that happens, then those companies won't be able to raise prices. But that's a different conversation. But in any case, we're seeing, again, an economy where you can see credit stress, consumption stress on the lower income side. Chipotle, or they're talking about, student loan debt has come back, and delinquencies. That there's an entire lower shift of spending that's getting hit, and the Federal Reserve has acknowledged that to a degree. Then you see stocks being elevated, homeowners doing good. So in that context, you can see why the labor data is getting slower, because if you have manufacturing declining in jobs, if you have residential construction declining in jobs, if you have housing permits in recession, those aren't real. You don't see that in an expansionary, but the consumption of goods and services and other things are still keeping things at bay. And again, for the new home sales sector, when rates move down towards 6%, new home sales hit a 3-year high. That number is going to get revised down a little bit. How the builders' confidence data, because we don't have permits, their 6-month outlook has really improved. So there are some benefits in there. But the jobs data is the interesting one, because whenever we start a year out, I always give an estimate of where I thought jobs growth would be. And I'm usually typically lower than a lot of people just because I adjust things to population. I don't think the US can have these really big job prints anymore. Last year in 2024, I was always under all the reports, and then after the revisions, right on target, basically on the top end of the forecast. But early this year, noticeably weaker, like no equivocation whatsoever. This was not a good year in the labor market right off the bat. The jobs data was noticeably getting softer. So whenever people want to say this is all population growth, this is it, the US will never have a big job market ever again because it doesn't have the labor force growth anymore. I question that theory, but in any case, some people are using that. Job openings, if you look at Indeed's job openings, it's been getting softer. If I look at the Revlon jobs data, it went negative. If I look at ADP 3-month average, it's below 10,000 a month. So there's things there that could show you there's some stress, but we're not completely breaking on the consumption side yet.
When you look at the kind of jobs, can you class them into certain categories? You know how in the past we've had like, okay, here's, you know, the tech companies are getting hit, or like you've talked about manufacturing and construction jobs. Like, is it across the board? Is it concentrated in certain areas?
Right now, manufacturing jobs have been losing since the end of 2022, and literally no one wants to talk about that. But recently, we have specialty contract construction jobs losing jobs. We have residential construction losing jobs. Of course, the federal government, which helped the total jobs number last year, that growth has slowed down a lot. So healthcare services, has been performing well. In a service-based economy, people that, the service sector jobs are holding up. But it's one of these things where we're kind of stuck here. And part of the thing is, I remember 2018 and 19 and business investment. Like if we didn't have the AI CapEx boom, oh man, things would be different, because business investment back in the first trade war tap dance basically went to zero, even with the tax cuts and everything. Like companies didn't know what to do. Now we have a situation to where, are the tariffs even going to be allowed to stay? So we just went through this whole entire year, and very soon we might be having to give it all back, which makes it very interesting that going out in the future, they passed the tax cuts because they were using the revenue from the tariffs, So if the tariff money goes back, companies are going to get back money. You still have the tax cuts. And if goods inflation doesn't pick up, that's not a bad looking 2026, right? In that format, if you're telling me goods pricing have been picking up, if those things start to fade, you got the tax cuts in place and rates stay lower and energy stays lower, and the dollar stays lower, you got something workable there that could be a positive. But that assumes that the Supreme Court shuts down the tariffs, they give all their money back, and they don't try to do anything. Because what we've seen is goods inflation has picked up. You cannot say it hasn't. And now you're collecting more and more revenue, and all the supply that was brought in where, companies weren't, passing it down because they didn't need to yet. It's a little bit different going into 2026. So I think it's a really interesting backdrop. I mean, it's weird to say this, but the Supreme Court can really change how I might look at, the economy going out in the future. And, even today, the Senate was talking about, hey, listen, we really need to get this government open again. It's now we're threatening airlines, less travel out there. It's going to be the holidays. So we have a lot of noise right now with the economy as well. Right, we have labor force growth isn't big. We have the government shutdown. We have the tariff situation, and for those that track data in 2018 and 19, there's a lot of similarities into there. But then we fall back to household balance sheets. Consumption is holding up. Homeowners are doing well. They do the big chunk of consuming. So it is one of these very, very unique economic cycles. But we might get a lot of clarity going out in the next 30 days. I mean, we might have the government shut down. We might have the tariffs gone, the tax cuts in place. If rates stay lower, energy prices stay lower, that can keep consumption going into 2026.
So it is a little confusing to me, though, because I know you're always like labor over inflation. But if inflation is going up, you said inflation is rising, how does that lead to lower rates?
It did.
Okay, well, tell me.
Labor over inflation. The labor market got weaker. It is an interesting year in that normally you don't see the Fed cut rates when inflation is this high. That's not a normal occurrence. But our thing has been the labor market is going to override everything. Again, multiple reasons for rates could not go down. Treasury supply. We're going to have big bond auctions coming up this week as well. Deficit spending. People always go, deficits are rising, rates have to go high. That's not a thing. The bond market is always weighted economic data and labor data slowing down as their primary driver of rates going down. They did it in 2023, they did it in 2024, and they did it in 2025. Except 2025 was the first year that authentic labor data was slowing down. Let's be mindful here. It wasn't that long ago that Jerome Powell went on TV and said, the labor market's fine. It wasn't that long ago where Beth Hammack says, the labor market's robust. You really want people in charge that literally missed this? So labor market's slowing, not breaking. Breaking, jobless claims rising, growth slows down, industrial production slows down, retail sales. So we're not at that stage yet. But I would say that you're more prone to any kind of shock really tilting things worse. So it's something to think about. But then we might get a lot of things changed in the next few weeks. We might not have tariffs anymore. We got the government open. The Fed has already cut rates. Energy prices are lower. That's, the history of politics and inflation, man. No politician survives inflation bursts, right? That's just a history. Like, everyone thinks they can do it, but it isn't. So there's a lot of stuff out there that can get cleared up in the next 30 to 60 days, getting ready for 2026. But again, rates going lower, the 10-year yield going lower, the Fed funds going lower are all positives.
Right. So let's talk about housing. Housing, you put housing in a recession in 2022. It's been there ever since. So, what kind of low rates are we talking about that could get housing out? Or on the other side, like, is the economy doing worse or better? What's the impact of all of this if I'm a housing professional?
Okay, so if you can get rates to just 6% and just hold it down there, the builders have multiple times told you they can work with this. This is why when we channel these rates out, we go, okay, it's really 6.64 down towards 6. If you could just hold it here, right? And we see it again now. We see it again. It's interesting where the Wall Street Journal has some very questionable headlines on housing data. They're like, oh my God, we're bringing the ARM loans back that were popular. Like, right. These ARM loans were the same ARM loans no, they weren't. If you're an educated person who did any reading on the 2008, these are not the ARM loans back then. Shame on the Wall Street Journal for posting that clickbait out there. And somebody should have came out there, and I'm surprised John Burns Real Estate didn't slap that down right away, because these are not the ARM loans back then. But what they also say is that the builders aren't able to sell their homes. Well, remember, the transaction models of builders, they're not very high velocity, but if they can get their confidence going, 6-month outlooks going, we saw this in the end of 2022 going into 2023, right? There was a similar backdrop. Back then in 2023, residential construction workers were losing their jobs for a few months. Then rates went down to 6, and permits started to rise again. Those are things that will be beneficial right now. And the lower the Fed funds rate goes, the lower short-term interest rate cost goes, you could get some, maybe apartment construction making sense again with the collection of rent. Can they do this to make money? So we can get there. The question I've always said is that it's really hard for me, with the Federal Reserve doing moderate restrictive policy, to get mortgage rates below 5.75, right? If it's 5.75, a lot of things change. But under this regime, it's just difficult, right, to go there. So this is why we always say, when it gets down to 6%, the Fed freaks out, comes on the market. So what are you guys doing? Go back higher. But it's a little bit different this year, because the bond market said, hey, we're going to stay near down 4% until the labor market gets better, right? So it was a really good, interesting rebuke that the bond market did to the Fed last year. The bond market was pricing a recession, the growth rate of inflation was falling, and the Fed said, hey, listen, why are we doing this? And then the bond market had to quickly reverse course. Now, didn't do that, really. We're not, mortgage rates aren't back up to over 7% like they were last year. So it's a very tight needle right here with a lot of these economic data reports. But if you try to connect the dots and everything, there could be a shift in the next 30 to 60 days on the outlook of what things can happen. But clearly you can see, like the consumer confidence index. I just generally hate surveys anyway, but that thing is like the lowest levels in recent history, right? So obviously we're not unemployment rate isn't above 10%, or we're not having negative growth and jobs being laid off. But the survey data isn't very positive in that light. So I think it's an interesting backdrop for 2026 because of what can change in the next 30 to 60 days. But the key is keep oil prices lower, keep rates lower, and if the dollar stays at this levels, you can work with this. This was the Trinity impact, or the Trinity call for the White House. They needed these three things to kind of make things work, because we're still a consumption-based economy. But boy, it's just going to get interesting. It really is with the Supreme Court, and if they take the tariffs off, but they already passed the tax cuts on it, they're not going to rescind that, and all of a sudden money is going to go back to companies. And then if goods inflation starts to decelerate a little bit, and then the Fed says we can go a little bit lower, just saying, Wheeler, there's a threading of the needle. It's like 4th and 10, game on the line. You got one wide receiver going down the middle. You got double coverage, but if you get it right in there, there's something to work with in the future, but we'll see what happens.
So what you're saying is we need a Patrick Mahomes to step up
and
do it in the fourth quarter.
Patrick Mahomes will be running around, scrambling, and throwing stuff up in the air. We need someone like Mac Jones, because Mac Jones could throw those, bullets down the middle. But it was a fascinating week, because we saw the bond market just completely react to 180. Who would have thought this 3 years ago? ADP report 42,000. The bond yields just shoot up because, oh my God, the labor data, it's good. I'm like, but
we have that's a bad sign.
Yeah, you have such a low bar in the data. That's why I always tell people, when we were down under 4%, said, guys, we really need to be like, the jobs data needs to be like really negative, because the Fed just put the lowest bar in history. Like, okay, if we're not losing jobs, we're okay, So it is what it is. It is a confusing year in that side. There's so many cross numbers out here. But then on one hand, you have ISM new orders really blow out. You have 4% GDP forecast. Kevin Hassett, the White House Economic Council head, came on TV and said, you know what, the shutdown's really hurting our economy. We're going to have a very bad fourth quarter. We should cut rates more. I can't believe the Fed didn't cut rates more. Trump demanded more rate cuts. Kevin Hassett might be the next Fed chair, man.
That's a whole other conversation, right? As we get closer to that.
That's a whole. If the next Fed chairman is basically saying the president of the United States wants more rate cuts, really,
and that's what the Fed needs to do, right?
I mean, it's just you got to be somewhat in the middle. This is why Christopher Waller should be the next Fed chair. Should have announced it already, but.
Okay.
Interesting.
Last question. And of course, we're doing this on a Friday, so anything could happen between here and Monday when this is. But, I saw a headline that Trump is cleared, if he wanted to declare war on Venezuela. Of course, none of us know if that's going to happen. Wars are generally inflationary, correct? What kind of war would have to trigger something like that?
World War I and World War II were inflationary because they had price controls. So any of the regional wars, aren't inflationary like they used to be. In fact, it was one of the things that happened recently. Whenever Israel was attacking Iran, oil prices didn't really shoot up, or in a big fashion, and stay there, and bond yields didn't act like it did. So, no, that war against Venezuela is just not even on my radar in that, and it If someone is trying to make it inflationary, it's just basically the shortage of oil going out, something like that. Something like that, because part of the Trinity game plan was oil prices had to go lower. This Trump could not do what he wants to do if oil prices were at 80, 85, 90 to 100, right? Because people pay gas. Oh my God, people hate it when they have to pay more for gas because it's something they see every day. That's why gas prices and confidence data, to a degree is kind of matching. But outside of that, we're not going to have price controls because of a war with Venezuela. If you look at the history of inflation going back to 1870, yes, I've got charts like that. World War I and World War II were very inflationary. A lot of domestic production and price controls and rationing, stuff like that, because of World War. So that's a whole different process. Venezuela, I think we're just shooting a few boats down. whatever target. Looks like more of a side project for the White House than anything else.
All right, Logan, thank you so much for walking through all of that on a very interesting week that's just going to get more interesting.
Yes, it is.
All right, thanks. We'll talk again soon.